Howdy, Jacob here. Today we're looking at Affiliated Managers Group. It is the capital markets industry on 5 billion market cap, quite a bit higher enterprise value, about 6.4 billion. They operate as an investment manager company, providing investment services through mutual funds, institutional clients, and such. Growth is actually negative. You're probably looking at negative single-digit growth over the last 10 years, with gross margins down, operating margin up a little bit, and return on invested capital in the upper single digits. So not very impressed by what I'm seeing there. But again, if you can buy it for the right price, I'm definitely down. Balance sheet shows about 1.27 billion cash-like products on hand with 2.5 billion long-term debt. At 2.5 billion debt is just over about 2.5 years, their 5-year actual cash flow. But again, similar story to what we're seeing, negative free cash, or definitely very positive free cash flow. Capital expenditures are very low, but decreasing free cash flow, decreasing cash from operations, even with them making acquisitions over here, to where their use of cash now is really just buying back shares and the dividend that is 0.03%, paying out about 0.1% of their 5-year average free cash flow. So that's a comical low dividend. They're paying that's like an Nvidia dividend at this point. Okay, that's funny. But use of cash is really just share repurchases and acquisitions at this point. So, we can go get right to it. Revenue growth. If we're looking negative, I'm going to want a really good price for this thing. So, to me, a negative 1%. I think you give me an 8 terminal PE. I'm comfortable with that. Margins, free cash flow is quite a bit higher. Let's do a big range here, maybe 35 to 40. And they're buying back a lot of shares. How much can we buy back? So 5 billion market cap, 50 million is 1%. 50 million is 1%. So if they buy back with 400, that's 8. Then stock-based compensation is already 126 million. So we're looking at about 6% share repurchases. This is like 60% of their free cash flow going towards share reduction, the rest going towards trying to break even on the revenue side. And then, their margins are very substantial. So to me, it doesn't look so stupidly cheap that, I'd definitely be into it right now. But I could see how you could. They do have a little bit of debt here. So maybe they focus a little bit on the debt reduction. But, a 7 PE for a negative growing company. If they just decrease 1% a year, that might not be too terrible, especially with them buying back 7 to 10% of their shares a year. So you could see how this could be a buy, but again, based on the math, based on the projections I have right here, it's still going to have to fall 37%. And again, I didn't change his dividend because, they've kept that the same the last 3 years. So I don't know why it's just not nothing, but I think I'm comfortable with this. The company's majority of their money is going towards share repurchases, but the price just isn't cheap enough yet to really make me push into buying it. So I do hope you enjoy the video. Interesting company. Have a great rest of your day.